Good afternoon, everyone. We are the Group 3. So our chosen accounting standards are the IAS 12 and 19. IAS 12 is the income taxes, while IAS 19 is the employee benefits. So let's have first the IAS 12. So for the overview, IAS 12 income taxes implements a so-called comprehensive balance sheet method of accounting for income taxes, which recognizes both the current tax consequences of transactions and events and the future tax consequences of the future recovery or settlement of the carrying amount of an entity's assets and liabilities, and differences between the carrying amount and tax base of assets and liabilities and carried forward tax losses and credits are recognized, with limited exceptions, as deferred tax liabilities or deferred tax assets, with the latter also being subject to a probable profits test. Tax consequences, meaning any transaction or occurrence in which the managing member will engage or participate or will managing member will allow to occur as a result of a tax determination. Now let's have the history of the IAS-12. On April 1978, Exposure Draft E13 Accounting for Taxes on Income was published. On July 1979, IAS-12 Accounting for Taxes on Income was issued. On January 1989, Exposure Draft E33 Accounting for Taxes on Income was published. In 1994, IAS-12 1979 was reformatted. On October 1994, Exposure Draft E49 Income Taxes was published. On October 1996, IAS-12 Income Taxes was issued. Operative for financial statements covering periods beginning on or after January 1, 1998. On October 2000, limited revisions to IAS-12 was published, The Tax Consequences of Dividends. Operative for financial statements covering periods beginning on or after January 2001. On March 31, 2009, Exposure Draft ED 2009-2 Income Tax was published. Comment deadline July 31, 2009. Proposals were not finalized. On September 10, 2010, Exposure Draft ED 2010 Deferred Tax Recovering of Underlying Assets Proposed Amendments to IAS-12 was published. Comment deadline November 9, 2010. On December 20, 2010, amended by Deferred Tax Recovery of Underlying Assets. It is effective for annual periods beginning on or after January 1, 2012. On December 20, 2010, amended by Deferred Tax Recovery of Underlying Assets. It is effective for annual periods beginning on or after January 1, 2012. January 19, 2016, amended by Recognition of Deferred Tax Assets for Unrealized Losses, effective for annual periods beginning on or after January 1, 2017. On June 7, 2017, IFRIC 23, Uncertainty over Income Tax Treatments was issued, effective for annual periods beginning on or after January 1, 2019. On December 12, 2017, Annual Improvements to IFRS Standards 2015 to 2017 cycle, effective for annual periods beginning on or after January 1, 2019. And the current amendment is May 7, 2021, amended by deferred tax related to assets and liabilities arising from single transaction. It is amendments to IAS-12 effective for annual periods beginning on or after January 1, 2023. Let us have now the objective of the IAS-12. The objective of IAS-12 is to prescribe the accounting treatment for income taxes, and the principal issue here is to determine how to account for the current and future tax consequences of various transactions and other events of the current periods that are recognized in the financial statements of an entity, and future recovery of carrying amounts of assets or settlement of the liabilities in the entity's balance sheet or the statement of financial position about tax consequences of various transactions and events in the financial statements. IAS-12 makes it easy because you just need to account for taxes in the same way as for transaction itself. That's a very simplified view. So if you recognize the certain item in profit or loss, then its tax consequence, which is current or deferred income tax, is also recognized in profit or loss, and the same applies for the statement of other comprehensive income. So if the transaction goes to other comprehensive income, then its also tax consequence goes to other comprehensive income. Well, that's easy. IS-12 also guides us in the situation when the future recovery of the assets or settlement of liabilities leads to different tax payments in the future than they would be if that recovery or settlement had no tax consequences. So, simply speaking, what happens if the tax rules are different from the accounting rules? In this case, the entity is required to recognize deferred tax asset or deferred liability, well, with some exceptions.
As part of the overview, let us have a brief description of the following terms used in the standard IAS 12 income taxes and its meaning as specified. First is the accounting profit, which is the profit or loss for a period before deducting the tax expense and is based on PFRS. The next one is the income tax expense. This is computed as well using PFRS, and it is the aggregate amount in computing the profit or loss for the period in respect of the current tax and the deferred tax. The next one is the taxable profit, which is in contrary to the accounting profit, is determined in accordance with the rules established by the taxation authorities. And then the current tax expense, which is the amount of income taxes payable or recoverable in respect of the taxable profit for a period, and is computed in line with the taxation authorities of a given state or country. Like for example, here it is under Philippine tax laws. Then the next terms are the deferred tax liabilities and the deferred tax assets. First, the deferred tax liabilities. This is the amounts of income taxes payable in future periods in respect of the taxable temporary differences, while the deferred tax assets are the amounts of income taxes recoverable in the future period as a result of deductible temporary differences, carry forward unused tax losses, and carry forward unused tax credits. Since we have already mentioned a while ago the taxable and deductible temporary differences, let us trace back where these two stems from. So because of the varying treatments with taxes by the standard and as compared with the tax laws, this results to permanent and temporary differences. So first, the permanent differences is when an income or expense enter into the computation of either the accounting profit or the taxable profit, but not both. And this does not have future tax consequences. On the other hand, the temporary differences, this is the difference between the carrying amount and its tax base that give rise to either the taxable temporary differences and deductible temporary differences. So when we say taxable temporary differences, these results in taxable amounts for future periods, thus equates to deferred tax liability payable later on. And then the deductible temporary differences as opposed, this is results in amounts that are deductible in the future periods, thus a deferred tax asset. And for the last term, this is the tax base. For tax purposes, this is the amount attributed to the assets or liability. To compute for the deferred tax asset or liability, we have the following formula. First, we have to get the temporary differences by deducting the tax base from its carrying amount, and then afterwards, to get the deferred tax asset or liability to be recognized, we only have to multiply the temporary differences by its tax rate. So when the carrying amount is higher than its tax base, we have to recognize a deferred tax liability. While when the tax base is higher than its carrying amount, we have to recognize a deferred tax asset. And in determining the amount of temporary differences, the tax base for which the asset or liability will be recorded for tax purposes is crucial. Now we have the recognition of deferred tax liabilities. As defined in IAS 12, these are the amounts of income taxes payable in future periods in respect of the taxable temporary differences. The general principle underlying in it is that it is recognized for all taxable temporary differences, with the only exception to the following. First is the liabilities arising from the initial recognition of goodwill. Second, liabilities arising from the initial recognition of an asset or liability other than in business combination, which at the time of transaction does not affect either of the taxable or accounting profit. Third one is the liabilities arising from temporary differences associated with investment in subsidiaries, branches, and associates, and interest in joint arrangements, to the extent that the entity are able to control the timing of reversal differences, and it is probable that the reversal will not occur in the foreseeable future. The next one is the recognition of deferred tax assets. Deferred tax assets is recognized for all deductible temporary differences, including the unused tax losses and unutilized tax credits, to the extent that it is probable that taxable profit will be available against which deductible temporary differences can be utilized, unless the deferred tax asset arises from initial recognition of an asset or liability other than in business combination, which at the time of the transaction does not affect the accounting or the taxable profit. Deferred tax assets for deductible temporary differences associated with investment in subsidiaries, branches, associates, and interest in joint arrangements are only recognized to the extent that it is probable that the temporary difference will reverse in the foreseeable future and taxable profit will be available against which temporary differences will be utilized. When it is not probable that a deferred tax asset will be realized, it is either not recognized at all or reduced to its realizable value, whichever is appropriate in the situation. And the last one for my part in the overview of IAS 12 is the measurement of the deferred tax. So deferred tax assets and liabilities are measured at the tax rates that are expected to apply to the period when the asset is realized or the liability is settled. So based on the taxing rates or laws that have been enacted or substantively enacted by the end of the reporting period. And also take note that IAS 12 prohibits the discounting of deferred tax assets and liabilities.
Recognition of tax amounts for the period. Amount of income tax to be recognized. The following formula summarizes the amount of tax to be recognized in an accounting period. We have here tax to recognize for the period is equals to current tax for the period plus movement in deferred tax balances for the period. So where to recognize income tax for the period? Consistent with the principles underlying IAS 12, the tax consequences of transactions and other events are recognized in the same way as the items giving rise to those tax consequences. Accordingly, current and deferred tax is recognized as income or expense and included in profit or loss for the period, except to the extent that a tax arises from: first, the transactions or events that are recognized outside the profit or loss, in which case the related tax amount is also recognized outside the profit or loss. Second is in terms of a business combination, in which case the tax amounts are recognized as identifiable assets or liabilities at the acquisition date and accordingly effectively taken into account in the determination of goodwill when applying IFRS 3 business combinations. Let's have an example wherein an entity undertakes a capital raising and incurs incremental costs directly attributable to the equity transaction, including regulatory fees, legal costs, and stamp duties. In accordance with the requirements of IAS 32, Financial Instruments and Presentation, the costs are accounted for as a deduction from equity. Let's also assume that the costs incurred are immediately deductible for the tax purposes, reducing the amount of current tax payable for the period. When the tax benefit of the deduction is recognized, the current tax amount associated with the cost of the equity transaction is recognized directly in equity, consistent with the treatment of the costs themselves. IAS 12 provides the following additional guidance on recognition of income tax for the period. Where it is difficult to determine the amount of current and deferred tax relating to items recognized outside the profit or loss, for example, there are graduated rates or tax, the amount of income tax recognized outside of profit or loss is determined on a reasonable per rate allocation or using another more appropriate method. In the circumstances where the payment of dividends impacts the tax rate or results in taxable amounts or refunds, the income tax consequences of dividends are considered to be more directly linked to past transactions or events and so are recognized in profit or loss unless the past transactions or events were recognized outside of profit or loss. The impact of business combinations and the recognition of per combination deferred tax assets are not included in the determination of goodwill as part of the business combination but are separately recognized. The recognition of acquired deferred tax benefits subsequent to the business combination are treated as measurement period adjustment if they qualify for that treatment or otherwise are recognized in profit or loss. Tax benefits of equity-settled share-based payment transactions that exceed the tax-affected cumulative remuneration expense are considered to relate to an equity item and recognized directly in equity. We have here the presentation. Current tax assets and current tax liabilities can only be offset in the statement of financial position if the entity has the legal right and the intention to settle on a net basis. Deferred tax assets and deferred tax liabilities can only be offset in the statement of financial position if the entity has the legal right to settle current tax amounts on a net basis and deferred tax amounts are levied by the same taxing authority on the same entity or different entities that intend to realize the asset and settle the liability at the same time. Take note that the amount of tax expense or income related to profit or loss is required to be presented in the statements of profit or loss and other comprehensive income. And also, the tax effects of items included in other comprehensive income can either be shown net for each item or the items can be shown before tax effects with an aggregate amount of income tax for groups of items which is allocated between items that will and will not be reclassified to profit or loss in subsequent periods. Disclosure. IS 12.80 requires the following disclosures. Major components of tax expense or tax income. Here are some examples. We have current tax expense, any adjustments of tax of prior periods, amount of deferred tax expense or income relating to the origination and reversal of temporary differences. The amount of deferred tax expense or income relating to changes in tax rates or the imposition of new taxes, amount of the benefit arising from a previously unrecognized tax loss, tax credit, or temporary difference of a prior period, write-down or reversal of a previous write-down of a deferred tax asset, amount of tax expense or income relating to changes in accounting policies, and corrections of errors. IS 12.81 requires the following disclosures. Aggregate current and deferred tax relating to items recognized directly in equity. Tax relating to each component of other comprehensive income, and an explanation of the relationship between tax expense and the tax that would be expected by applying the current tax rate to accounting profit or loss, which can also be presented as a reconciliation of amounts of tax or reconciliation of the rate of tax. Changes in tax rates, amounts and other details of deductible temporary differences, unused tax losses, and unused tax credits, temporary differences associated with investments in subsidiaries, branches, and associates, and interest in joint arrangements. For each type of temporary differences and unused tax loss and credit, the amount of deferred tax assets or liabilities recognized in the statement of financial position and the amount of deferred tax income or expense recognized in profit or loss. Tax relating to discontinued operations, tax consequences of dividends declared after the end of the reporting period, information about the impacts of business combinations on an acquirer's deferred tax assets, recognitions of deferred tax assets of an acquiree after the acquisition date. And here are the other required disclosures. We have details of deferred tax assets, tax consequences of future dividend payments. In addition to the disclosures required by IAS 12, some disclosures relating to income taxes are required by IAS 1. Presentation of financial statements are as follows. Disclosure on the face of statement of financial position about current tax assets, current tax liabilities, deferred tax assets, and deferred tax liabilities. And lastly, disclosure of tax expense in the profit or loss section of the statement of profit or loss and other comprehensive income or separate statement if presented.
Let's have the amendments to Istock, the 2015 to 2017 cycle. So we have the comparison of before amendments and then the after amendments. So before, the income tax consequences of dividends are recognized when a liability to pay the dividend is recognized. The income tax consequences of dividends are more directly linked to past transactions or events than to distribution to owners. Therefore, the income tax consequences of dividends are recognized in profit or loss for the period as required by paragraph 58, except to the extent that the income tax consequences of dividends arise from the circumstances described in paragraph 58 A and B. So this is the deleted part when they apply the amendments. After the amendments, so the entity shall recognize the income tax consequences of dividends as defined in IFRS 9 when it recognizes a liability to pay a dividend. The income tax consequences of dividends are linked more directly to past transactions or events that generated distributable profits than to distributions to owners. Therefore, the entity shall recognize the income tax consequences of dividends in profit or loss, other comprehensive income, or equity according to where the entity originally recognized those past transactions or events. So annual improvements to IFRS Standards 2015-2017 cycle issued in December 2017. Added paragraph 57A and deleted paragraph 52B, an entity shall apply those amendments for annual reporting periods beginning on or after January 1, 2019. Earlier application is permitted. If an entity applies those amendments earlier, it shall disclose that fact. When an entity first applies those amendments, it shall apply them to the income tax consequences of dividends recognized on or after the beginning of the earliest comparative period. So, for the comparison of the two, the comparison between the before and the after amendments they still recognize the liability to pay a dividend. And the only difference is about where the entity recognizes the income tax consequences or dividends. So before, income tax consequences shall be recognized in profit and loss, but after, not just in profit or loss but also in other comprehensive income or the statement of the changes in equity. To simplify the amendments, make changes to IS-12 is only to clarify how adjustments to income taxes payable are recognized when the income tax rate payable is higher or lower if some or all of the net profits of the business are paid out as a dividend to shareholders. So let's elaborate the amendments. So the amount of income taxes payable by an entity is affected by dividends paid to shareholders of equity instruments. The amendments to IS-12 clarifies that the income tax consequences of dividends as defined by the IFRS 9, that is the distributions of profits to shareholders of equity instruments in proportion to their holdings, must be recognized at the same time as the liability to pay those dividends is recognized, and in profit or loss, other comprehensive income, or the statement of changes in equity, according to where the entity originally recognized the past transactions or events that generated the distributable profits from which the dividends are being paid. Coming to the change brought into related to the income taxes, which is the IS-12, now there are a lot of deliberations which is done by the ISB in their improvement to cycle, and there were a lot of queries which are coming from different stakeholders, and there were some situations where like if company is distributing some dividends which is actually released or which is actually function of kind of realization of an instrument which is classified either it's an equity classification was done or liability or it was valuing at the fair value through OCI, a kind of instrument. So instrument quality classification is totally depending on the IFRS 9. So financial instrument related. Now the question came like for putting the income tax related provisions, so where the particular tax effect for the deferred taxes effect should be accounted in relation to this different classification is indicated, like for example, if you haven't any financial instrument which has been classified due to some criteria were being met and they classified it either fair value through OCI or it was classified in equity or liability, kind of basing on their characteristics, and later on the company distributing the profit which is related to those instrument realization, so the tax effect of those dividends also will sit in the same bracket. Like for example, if it is related to an instrument which you are classified at fair value through other comprehensive income, so the relative tax also will be sitting on OCI, so that is why they have changed.
At this point, let us discuss the latest amendments to IAS 12, which is issued by the IASB on May 7, 2021, and it is all about the deferred tax related to assets and liabilities arising from a single transaction. So these are issued in order to address the potential concerns of inconsistency and interpretation by users in respect of the initial recognition exemption. So it simplifies whether the initial recognition exemption applies to certain transactions that frequently result in both an asset and a liability being recognized concurrently. Such instances might include the initial recognition of leases from the perspective of lessee, or asset retirement obligations or decommissioning liabilities. So before we tackle the changes, let us first have a recap of what does IAS 12 generally requires. So subject to certain recognition requirements for deferred tax assets, IAS 12 generally requires entities to recognize deferred tax assets arising from deductible temporary differences and deferred tax liabilities arising from taxable temporary differences. So deductible and taxable temporary differences are the result of differences between the carrying amount of an asset or liability and the statement of financial position and the tax base. So the tax base of an asset or liability is the amount attributed to that asset or liability for tax purposes. Recognizing deferred tax assets and liabilities results in a tax charge in the statement of comprehensive income that corresponds to when an entity recognizes amounts in the statement of comprehensive income rather than when an amount is included in the determination of the taxable profit for the tax purposes. Now let us analyze what is the initial recognition exemptions and why it has been amended. The initial recognition exemption is an exception to the requirement to recognize deferred tax assets and liabilities relating to all deductible and taxable temporary differences. Prior to the amendments, in IAS 12, paragraph 15, it states that taxable temporary differences, a deferred tax liability shall be recognized for all taxable temporary differences except to the extent that the deferred tax liability arises from the initial recognition of goodwill or the initial recognition of an asset or liability in a transaction which is not a business combination and at the time of the transaction affects neither the accounting profit nor the taxable profit. Also, in the paragraph 24, which is about the deductible temporary differences, before the amendments, it states that a deferred tax asset shall be recognized for all the deductible temporary differences to the extent that it is probable that the taxable profit will be available against which the deductible temporary difference can be utilized, unless the deferred tax asset arises from the initial recognition of an asset or liability in a transaction that is not a business combination and at the time of the transaction affects neither accounting profit nor taxable profit. If the criteria in the IRE are met, deferred tax is not recognized, regardless of the fact that the carrying amount and the tax base of the asset or liability differ. In 2019, the IASB has become aware that there were conflicting views as to whether the IRE applies to the taxable and deductible temporary differences arising when a lessee initially recognized a right-of-use asset and a liability arising from a lease, the same with the transactions associated with the commissioning obligations. Currently, there is diversity in practice when accounting for deferred tax on transactions that involve recognizing both an asset and a liability with a single tax treatment related to both. For example, a company may be entitled to a tax deduction on a cash basis for a lease transaction that involves recognizing a right of use of asset and the corresponding lease liability under IFRS 16 leases. A temporary difference may then arise on initial recognition of the right of use asset and the lease liability. When applying the initial recognition exemption to this temporary difference, a company may currently apply one of the following approaches. The first one is apply the IRE separately to the right of use asset and lease liability, which could lead to recognize the tax impacts in profit or loss when they are incurred and therefore recognize no deferred tax on the list. Second approach is to assess the right of use asset and lease liability together as a single or integrally linked transaction on a net basis, which leads to an outcome of recognizing deferred tax on a net temporary differences that arises after the initial recognition and is not subject to the initial recognition exemption. And the last approach is to choose not to apply the IRE, and the outcome is to recognize a deferred tax. So in short, not all companies reflect the future tax impacts of leases in their financial statements. As we are all aware, IFRS 16 leases requires a company to recognize a right of use asset and a lease liability for leases. Over its lease term, the company recognizes depreciation and interest expense as it uses the lease assets and settles the lease liability. So conversely, many tax authorities provide tax deductions only when an entity makes a lease payments, not when a company recognizes depreciation and interest expense, which over time would result of combined tax charge fluctuating rather than the recovery of the item's carrying values over time. This is the turning point when the IASB amended the criteria to which the IRE applies. Specifically in the paragraph 15 and 24, this clarifies that the exemption does not apply to the transactions such as leases and the commissioning obligations. This transaction gives rise to equal and offsetting temporary differences. So after the amendments, the paragraph 15 of the IAS 12 states now that a deferred tax liability shall be recognized for all taxable temporary differences except to the extent that the deferred tax liability arises from the initial recognition of goodwill or the initial recognition of an asset or liability in a transaction which is not a business combination and at the time of the transaction affects neither the accounting profit nor the taxable profit, and at the time of transaction does not give rise to equal taxable and deductible temporary differences. While the paragraph 24 of the IAS 12 states that after the amendments now states that a deferred tax asset shall be recognized for all deductible temporary differences to the extent that it is probable the taxable profit will be available against which the deductible temporary differences can be utilized unless the deferred tax asset arises from the initial recognition of an asset or liability in a transaction that is not a business combination at the time of the transaction affects neither accounting profit nor taxable profit, and at the time of transaction does not give rise to equal taxable and deductible temporary differences. So for us to fully understand the amendments done to IAS 12 initial recognition exemption, here is an example problem to illustrate how a company applies the said amendments. So company C enters into a 10-year list of a building and recognizes a right of use asset and a lease liability of 450. In addition, C incurs initial direct cost of 20. On commencement of the lease, C records the following entries under IFRS 16 leases. So debit, right of use asset for 150 and credit, lease liability for 150. So this is to recognize the lease liability and the right of use asset. Also, we will record a debit of right of use asset 20 and cash 20 to recognize the initial direct cost. So the local tax legislation allows tax deduction for lease payments and initial direct costs when they are paid. Economic benefits that will flow to C when it recovers the carrying amount of the right of use of asset will be taxable. So after considering the applicable tax legislation, C concludes that the tax deductions that it will receive for lease payments relate to the repayment of the lease liability. and the corporate tax rate is 20%. So C determines the temporary differences that arise on initial recognition of the lease, and it is as follows. As we can see, the tax base of the initial direct cost is 0 because C has already used the deduction for tax purposes when it made the payment. Because this transaction affected the taxable profit on initial recognition, C recognizes a deferred tax liability for the taxable temporary differences of 20. And then the tax base of the right of use of asset is 0 because the tax deduction relates to the lease liability and no tax deduction will be available for the asset. And the last one, the tax base of the lease liability is 0 because it is determined as the carrying amount of 450 less the future tax deduction of 450. So on commencement of the lease, C records the following entry for the temporary differences in line with the latest amendments in IAS 12 Initial Recognition Exemption, and the company will record a debit of income tax expense for deferred tax asset 90 and a deferred tax liability of 90 to recognize the deferred tax on initial recognition of the lease. The amendments also included the paragraph 22A, which has been added to provide further clarification of this principle. Paragraph 22B, 22C of IAS 12 have also been amended. So the paragraph 22A states that transaction that is not a business combination may lead to the initial recognition of an asset and a liability, and at the time of the transaction affect neither accounting profit nor taxable profit. For example, at the commencement date of a lease, a lessee typically recognizes a lease liability and the corresponding amount as part of the cost of right-of-use asset. Depending on the applicable tax law, equal taxable and deductible temporary differences may arise on initial recognition of the asset and liability in such a transaction. The exemption provided by paragraph 15 and 24 does not apply to such temporary differences, and an entity recognizes any resulting deferred tax liability and asset.
What about lease advance payments and initial direct costs? The initial carrying amount of lease liabilities and ROU assets may differ due to the advance lease payments and/or initial direct cost. For example, modifying the lease example above, assume that the lessee had made an advance lease payment of CU50 and incurred initial direct cost of CU15. The carrying amounts of the lease liability and ROU assets at initial recognition would be: first, lease liability is 450, open parenthesis 500 minus 50, which is the advance payment, close parenthesis. Second, ROU assets is equals to 515, open parenthesis 450 plus 50, advance payment plus 15 initial direct cost, close parenthesis. The IASB includes an examples and the amendments to IAS 12 to clarify how they should be applied in these circumstances. The advance payments or initial direct costs are analyzed as follows. On the left side, we have revised IRE criteria, which is the questions, and for the assessments is the answers. And if all the responses are yes, that means that IRE applies. First question we have, does the difference arise from the initial recognition of an asset or liability? The answer is, the advance lease payments and initial direct costs arise from the initial recognition of a lease. Second, is the transaction not a business combination? The answer is yes. Entering into the lease contract does not meet the definition of a business combination. Third, at the time of the transaction, is neither accounting profit nor taxable profit affected? The answer is no. Taxable profit is affected at the time of the transaction because the advance payments and initial direct costs are deducted from taxable profit when paid. Last question, at the time of the transaction, does the transaction not give rise to equal taxable and deductible temporary differences? The answer is not applicable. The lease liability and the related component of the lease assets cost have been analyzed as follows. On the left side, we have the revised IRE criteria, and on the right side, we have the assessments. First question we have, does the difference arise from the initial recognition of an asset or liability? The answer is the differences arises due to the initial recognition of the lease. Neither the lease liability or the corresponding amount of the lease assets cost have tax basis. Second, is the transaction not a business combination? The answer is yes. Entering into the lease contract does not meet the definition of a business combination. Third, at the time of the transaction, is neither accounting profit nor taxable profit affected? The answer is yes. Neither accounting profit or taxable profit are affected at the time of the transaction. Lastly, at the time of the transaction, does the transaction not give rise to equal taxable and deductible temporary differences? The answer is no. The lease liability and the related components do give rise to equal taxable and deductible temporary differences. So we have here the list and its tax effects on initial recognition are summarized as follows. Here is the chart. And as you can see, we have here the carrying amount, tax base, deductible or taxable temporary difference, and then the deferred tax assets or liabilities. For the lease assets, we have the advance lease payment, initial direct cost, amount of the initial measurement of the lease, and the lease liability. For the carrying amount, we have the following: 50, 15, 450, and 450. And then we have the deductible taxable temporary differences. We have negative 50, negative 15, negative 450, and then 450. For the deferred tax asset liability, we have negative 10, negative 3, negative 90, and then a positive 90. Are leases the only transactions affected by the amendments? The answer is any transaction that gives rise to equal taxable and deductible temporary differences may be affected by the change in the scope of the IRE. For example, entities might enter into the transactions where they acquire an asset and simultaneously incur an obligation to remediate the asset in the future, sometimes referred to as an asset retirement obligation or ARO, or decommissioning liability. An ARO would be recorded by recognizing the liability with offsetting entry recorded as component of the cost of the asset acquired. Which entities might be affected by the amendments? As noted above, some entities may previously have considered that the IRE applied in these cases. If so, then the amendments will affect those entities. What are the transitional requirements? Entities are required to apply the amendments for annual reporting periods beginning on or after 1st of January 2023. Earlier application is permitted. If an entity applies the amendments for an earlier period, it is required to disclose that fact. Entities are required to apply the amendments to transactions that occur on or after the beginning of the earliest comparative period presented. For example, from 1st of January 2022, for entities providing 1 year of comparative information, the IASB decided to not require retrospective application of the amendment because doing so would require entities to retrospectively assess whether each lease and decommissioning obligation gave rise to equal taxable and deductible temporary differences, which may be onerous. At the beginning of the earliest comparative period presented, entities are required to recognize deferred tax assets, which is subject to the recoverability requirements of IAS 12, and deferred tax liabilities associated with: first, ROU or right-of-use assets and lease liabilities, and second, decommissioning, restoration, and similar liabilities, and the corresponding amounts recognized as part of the cost of the related assets. The effect of recognizing these deferred tax items is reflected as an adjustment to the opening balance of retained earnings or other components of equity as appropriate as at that date.
Overview of International Accounting Standard 19. IAS 19 prescribes the accounting for all types of employee benefits except share-based payment, to which IFRS 2 applies. Employee benefits are all forms of consideration given by an entity in exchange for service rendered by employees or for the termination of employment. IAS 19 requires an entity to recognize a liability when an employee has provided service in exchange for employee benefits to be paid in the future, and an expense when the entity consumes the economic benefit arising from the service provided by an employee in exchange for employee benefits. The employee benefits to which this standard applies include those provided under A. Formal plans or other formal agreements between an entity and individual employees, groups of employees, or their representatives. B. Under legislative requirements or through industry arrangements whereby entities are required to contribute to national state, industry, or other multi-employer plans. Or C. By those informal practices that give rise to a constructive obligation. Informal practices give rise to a constructive obligation where the entity has no realistic alternative but to pay employee benefits. An example of a constructive obligation is where a change in the entity's informal practices would cause unacceptable damage to its relationship with employees. Employee benefits include the following: A. Short-term employee benefits, such as the following, if expected to be settled wholly before the 12 months after the end of the annual reporting period, in which the employees render the related services, wages, salaries, and social security contributions, paid annual leave and paid sick leave, profit sharing and bonuses, and non-monetary benefits for current employees. B. Post-employment benefits, such as the following: retirement benefits and other post-employment benefits, such as post-employment life insurance and post-employment medical care. C. Other long-term employee benefits, such as the following: long-term paid absences such as long service leave or sabbatical leave, jubilee or other long service benefits, and long-term disability benefits. And D. Termination benefits. Employee benefits include benefits provided either to employees or to their dependents or beneficiaries and may be settled by payments made either directly to the employees, to their spouses, children, or other dependents, or to others, such as insurance companies. An employee may provide services to an entity on a full-time, part-time, permanent, casual, or temporary basis. For the purpose of this standard, employees include directors and other management personnel. Short-term employee benefits. These are recognized when the employee has rendered the service and are measured at the undiscounted amount of benefits expected to be paid in exchange for that service. Post-employment benefits that are payable after the completion of employment. Plans providing these benefits are classified as either defined contribution plans or defined benefit plans, depending on the economic substance of the plan as derived from its principal terms and conditions. Under IAS 19, when an employee has rendered service to an entity during a period, the entity recognizes the contribution payable to a defined contribution plan in exchange for that service as a liability and as an expense, unless another standard requires or permits the inclusion of the contribution in the cost of an asset. Under IAS 19, an entity uses an actuarial technique to estimate the ultimate cost to the entity of the benefits that employees have earned in return for their service in the current and prior periods. discounts that benefit in order to determine the present value of a defined benefit obligation and the current service cost, deducts the fair value of any plan assets from the present value of the defined benefit obligation, determines the amount of the deficit or surplus, and determines the amount to be recognized in profit and loss and other comprehensive income in the current period. Those measurements are updated each period. Other long-term benefits. These are all employee benefits other than short-term employee benefits, post-employment benefits, and termination benefits. Termination benefits. These are employee benefits provided in exchange for the termination of an employee's employment. An entity recognizes a liability and expense for termination benefits at the earlier of the following dates: when the entity can no longer withdraw the offer of those benefits, and when an entity recognizes costs for a restructuring that is within the scope of IAS 37 and involves the payment of termination benefits. Let's move forward to the history of IAS 19. In April 2001, the International Accounting Standards Board adopted IAS 19 Employee Benefits, which had originally been issued by the International Accounting Standards Committee in February 1998. IAS 19 Employee Benefits replaced IAS 19 Accounting for Retirement Benefits in the financial statements of employers issued in January 1983. IAS 19 was further amended in 1993 and renamed as IAS 19 Retirement Benefit Costs. The board amended the accounting for multi-employer plans and group plans in December 2004. In June 2011, the board revised IAS 19. This included eliminating an option that allowed an entity to defer the recognition of changes in net defined benefit liability and amending some of the disclosure requirements for defined benefit plans and multi-employer plans. In November 2013, IAS 19 was amended by defined benefit plans, employee contributions. The amendment simplified the requirements for contributions from employees or third parties to a defined benefit plan, when those contributions are applied to a simple contributory plan that is linked to service. Other standards have made minor consequential amendments to IAS 19, including annual improvements to IFRS 2012 to 2014 cycle issued September 2014, annual improvements to IFRS Standards 2014 to 2016 cycle issued December 2016, IFRS 17 insurance contracts, plan amendment, curtailment, or settlement issued February 2018. And last, amendments to references to the conceptual framework in IFRS standards.
To continue the discussion, I am here to present the objective, recognition, measurement, and disclosure of IAS 19. The objective of IAS 19 is to prescribe the accounting and disclosure for employee benefits, requiring an entity to recognize a liability when an employee has provided service and an expense when the entity consumes the economic benefits of employee service. It was already mentioned earlier that there are 4 categories of employee benefits, and all those 4 has different treatments as to recognition, measurement, and disclosure. Starting with the short-term employee benefits. The employee benefit is recognized when an employee renders service. It is recognized as an expense unless it can be included in the cost of an asset. There are also what we call short-term paid absences. The most common paid absences are holidays, sick leave, and maternity leave. IAS 19 distinguishes between accumulating and non-accumulating paid absences.
Accumulating paid absences are those that are carried forward and can be used in future periods if the current period's entitlement is not used in full. This is usually the case with holidays, though it varies between countries. Non-accumulating paid absences, on the other hand, do not carry forward. They lapse if the current period's entitlement is not used in full and do not entitle employees to a cash payment for unused entitlement on leaving the entity. This is usually the case with sick leave or maternity leave. For accumulating paid absences, employee benefit expense should be recognized when the employee renders service and earns the right to a paid absence. If the paid absences is non-vesting, for instance, on leaving the company, an employee does not receive any cash payment for unused absence, entities should still recognize employee benefit when this employee renders service, but taking into account the estimated unused absences. Meanwhile, for non-accumulating paid absences, entities should not recognize any expense until the absence occurs. Moving on to the disclosure, this standard does not require specific disclosures about short-term employee benefits, but other IFRS may require disclosures. For example, IAS 24 requires disclosures about employee benefits for key management personnel, and IAS 1, presentation of financial statements, requires disclosure of employee benefit expense. Now, let us discuss post-employment benefits. Post-employment benefit plans can be either defined contribution plans or defined benefit plans. This distinction is crucial as the accounting treatment is completely different. Under the defined contribution plan, accounting is set out in IAS 19.50 to 54 and is simple in most cases. The employee benefit is recognized when an employee renders service similarly to regular remuneration. There is no actuarial valuation or discounting involved. When an employee has rendered service to an entity during a period, the entity shall recognize the contribution payable to a defined contribution plan in exchange for that service. First, as a liability after deducting any contribution already paid. If the contribution already paid exceeds the contribution due for service before the end of the reporting period, an entity shall recognize that excess as an asset to the extent that the prepayment will lead to, for example, a reduction in future payments or a cash refund. And second, as an expense, unless other standard requires or permits the inclusion of the contribution in the cost of an asset. For example, IAS 2 inventories and IAS 16 property, plant, and equipment. For the disclosure, entities are required to disclose the amount recognized as an expense for defined contribution plans. This relates also to state-run plans when entities are required to make contribution on the top of an employer's gross salary, but it's true that most entities do not provide such a disclosure. Meanwhile, defined benefit plans may be unfunded or they may be wholly or partly funded by contributions by an entity and sometimes its employees into an entity or fund that is legally separate from the reporting entity and from which the employee's benefit or the employee benefits are paid. The payment of funded benefits when they fall due depends not only on the financial position and the investment performance of the fund, but also on an entity's ability and willingness to make good any shortfall in fund's asset. Therefore, the entity is, in substance, underwriting the actuarial and investment risks associated with the plan. Consequently, the expense recognized for a defined benefit plan is not necessarily the amount of the contribution due for the period. Accounting by an entity for defined benefit plans involves the following steps. First, using actuarial techniques to make a reliable estimate of amount of the benefit that employees have earned in return for their service in the current or prior periods. This requires an entity to determine how much benefit is attributable to the current and prior periods and to make estimates about demographic variables such as employee turnover and mortality and financial variables such as future increases in salaries and medical costs that will influence the cost of the benefit. Second, discounting that benefit using the projected unit credit method in order to determine the present value of the defined benefit obligation and the current service costs. Third, determining the fair value of any plan assets. Fourth, determining the total amount of actuarial gains and losses and the amount of those to be recognized. Second to the last, where a plan has been introduced or changed, determining the resulting post-service cost. And lastly, where a plan has been curtailed or settled, determining the resulting gain or loss. Where an entity has more than one defined benefit plan, the entity applies these procedures for each material plan separately. In some cases, estimates, averages, and computational shortcuts may provide a reliable approximation of the detailed computation illustrated in this standard. As for the disclosure, an entity shall disclose information that enables users of financial statements to evaluate the nature of its defined benefit plans and the financial effects of changes in those plans during the period. For the third category, other long-term employee benefits. Such benefits can be straightforward and similar to short-term benefits, with the exception that they are not expected to be settled within 12 months after the end of the year when the service was rendered. In this case, entities should look into accounting requirements relating to short-term benefits and consider discounting them. However, other long-term employee benefits can also take a form of defined benefit plans, and their accounting will be as complex as for post-employment benefits. This will be the case for Jubilee Awards. In this case, entities should look into requirements relating to post-employment benefits, distinguish between defined benefit and defined contribution plans, and apply IAS 19 requirements accordingly. It's important to note that actuarial gains or losses on the long-term benefits are included in PL. As for the measurement, one form of other long-term employee benefit is the long-term disability benefit. If the level of benefit depends on the length of service, an obligation arises when the service is rendered. Measurement of that obligation reflects the probability that payment will be required and the length of time for which payment is expected to be made. If the level of benefit is the same for any disabled employee, regardless of years of service, the expected cost of those benefits is recognized when an event occurs that causes a long-term disability. Moving on with the disclosure, another major difference between other long-term benefits and post-employment benefits relates to disclosure. IAS 19 does not require any specific disclosures relating to other long-term benefits. Although this standard does not require specific disclosure about other long-term employee benefits, other standards may require disclosures. For example, where the expense resulting from such benefits is material and so would require disclosure in accordance with IAS 1. When required by IAS 24, an entity discloses information about other long-term employee benefits for key management personnel. For the last category, termination benefits are a separate category of employee benefits as the obligation arises on termination of employment rather than during employee's services. However, not all benefits paid upon termination of employment are termination benefits. Entities should recognize termination benefits at the earlier of the following dates. First, when the entity can no longer withdraw the offer of those benefits. And second, when the entity recognizes costs for restructuring that is within the scope of IAS 37 and involves the payment of termination benefits. Under the measurement, usually, the measurement of termination benefits is straightforward as they take a form of a lump sum payment. Termination benefits are not provided for future service of an employee, therefore, they should be recognized in PL upfront, even if the payments are spread over time. If they take a more complicated form, an actuarial valuation may be needed. Sometimes, the termination benefit is a difference between a payment that an employee would receive if they left the company without an entity's offer and the higher payment that was made because the termination was an entity's initiative. As for the disclosure, IAS 19 does not specify any disclosure requirements relating to termination benefits.
Annual improvements to IFRS 2012 to 2014 cycle. The IASB uses the annual improvements process to make necessary but non-urgent amendments to IFRS if those amendments will not be included as part of any other project. By presenting the amendments in the form of a single document rather than as a series of piecemeal changes, the IASB aims to ease the burden of change for all concerned. Amendment to IAS 19 Employee Benefits. As a part of annual improvements to IFRS 2012 to 2014 cycle. Before amendment. Paragraph 83 of IAS 19. The rate used to discount post-employment benefit obligations, both funded and unfunded, shall be determined by reference to market yields at the end of the reporting period on high-quality corporate bonds. In countries where there is no deep market in such high-quality corporate bonds, the market yields at the end of the reporting period on government bonds shall be used. The currency and term of the corporate bonds or government bonds shall be consistent with the currency and estimated term of the post-employment benefit obligations. After amendment, Paragraph 83 of IAS 19. The rate used to discount post-employment benefit obligations, both funded and unfunded, shall be determined by reference to market yields at the end of the reporting period on high-quality corporate bonds. In currencies for which there is no deep market in such high-quality corporate bonds, the market yields at the end of the reporting period on government bonds denominated in that currency shall be used. The currency and term of the corporate bonds or government bonds shall be consistent with the currency and estimated term of the post-employment benefit obligations. Annual improvements to IFRS 2012 to 2014 cycle issued in 2014 amended paragraph 83. An entity shall apply that amendment retrospectively in accordance with IAS 8 accounting policies, changes in accounting estimates and errors for annual periods beginning on or after 1 January 2016. Earlier application is permitted. If an entity applies that amendment for an earlier period, it shall disclose that fact. The comparison. As you can see, new text is underlined and deleted text is struck through. The second paragraph is added. The basis for conclusions on the amendment to IAS 19. The IASB was asked to clarify the requirements of IAS 19 to determine the discount rate in a regional market sharing the same currency. The issue arose because some think that the basket of high-quality corporate bonds should be determined at a country level and not at a currency level. Because paragraph 83 of IAS 19 states that in countries in which there is no deep market in such bonds, the market yields at the end of the reporting period on government bonds shall be used. The IASB noted that paragraph 83 of IAS 19 states that currency and term of the corporate bonds or government bonds shall be consistent with the currency and estimated term of the post-employment benefit obligations. The IASB proposes to amend paragraph 83 of IAS 19 through the annual improvements process in order to clarify that the high-quality corporate bonds used to estimate the discount rate should be issued in the same currency in which the benefits are to be paid. Consequently, The depth of the market for high-quality corporate bonds should be assessed at a currency level.
Plan amendment, curtailment, or settlement issued in February 2018 requires an entity to use updated actuarial assumptions to determine current service cost and net interest for the remainder of the annual reporting period after the plan amendment, curtailment, or settlement when the entity remeasures its net defined benefit liability or asset in accordance with paragraph 99. The IFRS Interpretations Committee was asked to clarify the calculation of current service cost and net interest for the remainder of an annual period when a plan amendment or curtailment occurs. IAS 19.99 requires that the net defined benefit liability or asset be measured using the current fair value of plan assets and current actuarial assumptions, which will reflect changes made to the plan. In contrast, the basis of conclusions of IAS 19 implies that an entity should not revise any assumptions during the period when calculating the current service costs and net interest, even if an entity measures the net defined benefit liability or asset using revised assumptions. Similarly, IAS 19.123 states that net interest on the net defined benefit liability or asset is based on that at the start of the annual period, taking into account changes in the net defined benefit liability or asset during the period as a result of contribution and benefit payments. But IAS 19.123 makes no reference to changes resulting from plan amendments, curtailments, or settlements. They concluded that revising the assumptions when measuring the net defined benefit liability or asset, but not when calculating current service cost or net interest, was inconsistent. However, because the committee was not able to solve the problem by developing an interpretation, it instead recommended that the IASB amend IAS 19. Paragraphs BC 173A to 173F explain the board's rationale for the amendments. Before the amendments, IAS 19 did not require an entity to use updated assumptions to determine current service cost and net interest for the period after the plan amendment, curtailment, or settlement. Paragraphs BC 64 explain the board's rationale for those previous requirements. Because the previous requirements no longer apply, the board deleted paragraph BC 64. The board concluded that it is inappropriate to ignore the updated assumptions when determining current service cost and net interest for the remainder of the annual reporting period. In the board's view, using updated assumptions to determine current service cost and net interest for the remainder of the annual reporting period provides more useful information to users of financial statements and enhances the understandability of financial statements.
Before we proceed to the discussion of the amendment, let us first have some key terms and definitions related to the amendment concerning post-employment benefits. A while ago, my groupmate Ms. Ramos already discussed what are post-employment benefits, under which she mentioned defined contribution plan and defined benefit plan. In a defined contribution plan, accounting is straightforward, no actuarial assumption is needed, thus there is no actuarial gain or loss, and the obligation is measured on an undiscounted basis, except when they are not expected to be settled wholly within 12 months after the end of the period. On the other hand, in a defined benefit plan, accounting is complex because of actuarial assumptions required to measure the obligation, thus, there is a possibility of actuarial gain or loss and the obligation is measured on a discounted basis. Specifically, the amendment relates to plan amendment, curtailment, or settlement under defined benefit plan, so we will be discussing first the terms it involves. Defined benefit cost. Related to a defined benefit plan is the defined benefit cost. Its components are 1. Service cost, which comprises of current service cost, past service cost, and any gain or loss on settlement. 2. Net interest, which comprises of interest expense on defined benefit obligation, interest income on plan assets, and interest expense on effect of asset ceiling. 3. Remeasurements, which comprise of remeasurement of plan assets, remeasurement of projected benefit obligation, and remeasurement of the effect of asset ceiling. The service cost and net interest are included in profit or loss as component of employee benefit expense, while all of the remeasurements are fully recognized through other comprehensive income. Accordingly, it can be said that the defined benefit cost is partly profit or loss and partly comprehensive income. Current service cost. Current service cost is an increase in the present value of the defined benefit obligation resulting from employee service in the current period. Since current service cost nga siya, it pertains to the current period and it is the cost associated to the provision of future benefits in exchange of the services rendered by the employees in the present period. It has been mentioned a while ago that the defined benefit obligation is measured on a discounted basis. Hence, the use of present value when computing the current service cost. And notice on the word increase. Since every period nagre-recognize ng current service cost ang entity in relation sa future benefits na ipoprovide niya sa employees kapalit ng services na nirender nila in the current period, such results to the increase as well in the present value of the defined benefit obligation. Past service cost. Past service cost is the change in the present value of defined benefit obligation for employee service in prior periods resulting from a plan amendment or curtailment. Ang sabi, change in the present value of defined benefit obligation. Hindi ni-specify whether increase or decrease basta change, meaning may pagbabago. And since mayroon ng service na na-render in the past, apektado yung service cost sa prior periods dahil sa change na nag-occur currently, and accordingly, dapat i-measure and i-recognize yung effect noon sa defined benefit obligation. Plan amendment. This includes introduction of defined benefit plan or changes to an existing benefit plan. Kapag mayroong plan amendment, it's either from wala, nagkaroon ng defined benefit plan, or kaya naman nagkaroon ng pagbabago doon sa existing ng defined benefit plan. Plan curtailment. This is a significant reduction by the entity in the number of employees covered by the defined benefit plan. This may arise from an isolated event such as closing of a plant, discontinuance of an operation, or termination or suspension of a plan. According to Sir Win Balyada, usually raw nagre-result sa addition sa defined benefit obligation kapag plan amendment. But pwede rin naman daw na mag-result sa deduction, mas common lang na mag-result sa addition. However, kapag naman daw plan curtailment, always deduction siya, and di ba nabanggit din naman kanina sa definition ng plan curtailment na it involves a significant reduction sa number of employees na covered ng plan. Settlement gain or loss. This is simply the difference between the settlement price and the present value of the defined benefit obligation and the date of settlement. Net interest on defined benefit liability or asset. This is the change in the defined benefit obligation, plan assets, and effect of asset ceiling as a result of the passage of time. So dahil lumipas ang panahon, nagkakaroon ng pagbabago sa value ng obligation at ng plan assets, and thus, we measure and recognize the associated interest. Plan assets. Plan assets are comprised of assets held by a long-term benefit fund and the qualifying insurance policies. Diba we have defined benefit obligations na once employment is completed or the employee retires, kailangang bayaran sa employee. Siyempre si employer entity, hindi naman siya papayag na lolobo lang yung obligations na yon nang walang ginagawa. This is where plan assets enter. The employer entity makes contributions to the plan assets held by a third party, so when the time for payment comes, mayroon siyang huhuguting pambayad and hindi gulpihan yung paglalabas niya ng pera para ipambayad nga sa post-employment benefits ng employees. Projected benefit obligation. This is the actuarial present value of all benefits attributed by the pension benefit formula to employee service rendered before a specified date based on future compensation level or future salary increases. The defined benefit obligation contemplated under IAS 19 is the projected benefit obligation. In the definition, we can notice the word actuarial. This is because the best professional to compute for the benefit obligation is an actuary. In the definition, present value is mentioned. This is so because the benefits will be received after a long time, but employees render services currently or every year. That is why the obligation needs to be in its present value, and in doing so, a formula called the pension benefit formula is used. So where is this formula applied? The answer is to every year of service rendered by the employees, meaning every year the obligation of the entity employer accumulates. However, the amount of which does not depend upon the current salaries of the employees, but upon the future compensation level or future salary increases. Actuarial assumptions. Actuarial assumptions are entities' best estimate of the variables that will determine the ultimate cost of providing post-employment benefits. Actuarial assumptions are usually made by actuary, a mathematical expert best qualified to do the job. The standard encourages but does not require entities to involve a qualified actuary in the measurement of defined benefit obligation. Moreover, actuarial assumptions comprise of demographic and financial assumptions. Net defined benefit liability or asset. This is the difference between the present value of defined benefit obligation and the fair value of plan assets. If the fair value of plan assets is higher, then there is a surplus in a net defined benefit asset or a prepaid benefit cost. If the present value of the defined benefit obligation is higher, then there is deficit and a net defined benefit liability or an accrued benefit cost. Asset ceiling. Asset ceiling is the present value of any economic benefits available in the form of refunds from the plan or reductions in future contributions to the plan. Itong asset ceiling, possible lang siya kapag mas mataas yung fair value ng plan assets kumpara sa projected benefit obligation, and this just simply means the amount na pwedeng ma-refund ng entity mula sa excess contribution sa plan assets or kaya naman, amount na pwedeng ma-utilize as deduction sa subsequent contribution sa plan assets. Now that we are done defining key terms, let us now proceed to the discussion of the amendments. We have attached here a link which includes a paragraph-by-paragraph comparison of the amendments to IAS 19. You can visit this link if you want to see the detailed comparison. Hindi na po namin nilagay dito kasi sobrang haba yung report namin kasi babasahin ko lang din naman sila isa-isa sa inyo. And it will just boil down to the same discussion we'll be having afterwards. The summarized version of the amendments taking into consideration the important changes to the standard. So, let's begin. Amendments with regards to past service cost or the gain or loss on settlement. The amendments clarify that past service cost or of the gain or loss on settlement is calculated by measuring the defined benefit liability or asset using updated actuarial assumptions and comparing the benefits offered and plan assets before and after the plan amendment or curtailment or settlement, but ignoring the effect of the asset ceiling that may arise when the defined benefit plan is in a surplus position. To better explain and understand the amendment, let us use an illustrative example. So this example involves a plan amendment. An entity operates a defined benefit plan that provides for a benefit of 5% of final salary for each year of service. The benefits become vested after 5 years of service. On January 1, 2020, the entity improves the benefit to 6% of final salary for each year of service including prior years. From here, it is clear na mayroong amendments na naganap kasi nga from 5% of final salary, kinawang 6% yung benefit na marireceive ng employees after employment. This change is included on financial assumptions. At the date of the amendment on January 1, 2020, the present value of the additional benefits increased as follows. Employees with more than 5 years of service on January 1, 2020, 300,000 pesos. Employees with less than 5 years of service on January 1, 2020, an average period until vesting is 3 years, 150,000 pesos. Before I proceed pala, as per Sir Win Balyada's lecture, yung amounts na 300,000 and 150,000, actually daw yung nagko-compute niyan since it involves complex mathematics to come up with the amounts. So going back, whether vested or unvested, the standard states that past service costs should be recognized as an expense outright kasi nga na-render na yung service in the past. The total past service cost of 450,000, which is 300,000 plus 150,000, shall be recognized as expense immediately as component of the total benefit expense. The total amount is added to the defined benefit obligation. So if say, for example, there is already 1.5 million peso worth of defined benefit obligation. The 450,000 pesos will be added to it for a total of 1,950,000 pesos. Doon sa amendment kanina, kung matatandaan natin, sinabi na nakakalculate itong past service cost sa pamamagitan ng pagme-measure sa defined benefit liability or asset using updated assumptions at sa pagko-compare ng benefits offered and plan assets before and after the amendment. Here, ang updated assumptions natin is yung 6% ng final salary instead of 5%. And as a result, diba, nagkaroon ng additional expense yung entity kasi tumaas yung benefit as compared before na ipoprovide niya sa employees, and that additional expense affects the defined or projected benefit obligation, which is subtracted from the fair value of the plan assets to arrive at the net defined benefit liability or asset. Moreover, with regards to asset ceiling, IAS 19 is now clear that the change in effect of the asset ceiling that may result from plan amendment, curtailment, or settlement is dealt with separately in other comprehensive income. Amendments with regards to current service cost and net interest on the net defined benefit liability or asset. As amended, an entity is now required to use the updated actuarial assumptions to determine current service cost and net interest for the remainder of the reporting period after the change to the plan as a result of amendment, curtailment, or settlement. Previously, an entity would have not revised any assumptions during the period when calculating the current service cost and net interest, even if an entity measures the net defined benefit liability or asset using updated actuarial assumptions. Furthermore, in the case of the net interest, the amendments make it clear that for the period after plan amendment, the net interest is calculated by multiplying the net defined benefit liability or asset as remeasured under paragraph 99 of IAS 19 with the discount rate used in the remeasurement, also taking into account the effect of contributions and benefit payments on the net defined benefit liability or asset. Simply put, kung dati hindi ginagamit yung updated assumptions related to plan amendment, curtailment, or settlement sa pagkakalculate ng current service cost and net interest for the remainder of the reporting period after the change to the plan, ngayon nire-require na ng standard na gamitin yung updated actuarial assumptions. For example, if an amendment is made to a defined benefit plan halfway through the year, the current service cost and net interest for the remaining 6 months of the year are recalculated using the same actuarial assumptions as those used to remeasure the net defined benefit liability or asset. Transition and effective date of the amendments. These amendments to IAS 19 should be applied to plan amendments, curtailments, or settlements occurring on or after the beginning of the first annual reporting period that begins on or after January 1, 2019. Early application is permitted, but an entity that chooses to do so must disclose that fact.